Well, good afternoon, everybody. It's Close of Business Tuesday, and in Houston, you know what that means. We got a big game tonight. So let me get the Go Astro stuff right up front. We got two spectacular guests today. We've got Sydney Isaacs and Blair Hennessy. They're from Abernathy McGregor, which is a strategic communications firm. We're going to talk to them about a lot of really interesting stuff. I reached out to them after they wrote a paper on employee activism, which is a really interesting subset of the activism world. But they've also got a ton of things to say. In particular, we're going to talk about deals and why they leak and what happens when they leak and how to course correct. So it's going to be fascinating. Sydney's the head of the Houston office. Blair's a senior part of the New York office. But let me just say welcome. We're so glad to have you guys.
Thank you, Maynard. Happy to be here.
Awesome. Okay. Wow. A lot of stuff going on. Mike Bradley, the screen is just, the calendar is totally full of earnings. What are you seeing? What are you noticing? We got an OPEC meeting this week. Talk to us.
Yeah, Maynard, the screen is a little bit mixed today, but you're right. This is the next week or two is going to be full of E&P earnings. As you remember, last week, the week before, was more of the oil service companies. And, one of the things we heard with those meetings is a lot of inflationary, supply chain issues. And what are we hearing on the E&Ps? What we're hearing on the E&Ps, we've only had a handful of large caps, but we're hearing, return of capital, return of capital, return of capital. And, not only just dividend, base dividend increases, but, variable dividend increases and share repos and all of the above. Because there's just an abundance of cash coming in. The one thing we're not hearing is about these companies looking to spend more in CapEx into 22. It's a bit early. Most of these guys are talking about, okay, OPEC surplus capacity needs to be at certain levels. Inventory globally have to be below certain levels, and global S&D has to be pre-pandemic levels. And two out of those three are there. The one that's not there is OPEC surplus capacity being eliminated. But that could be something we see in 22. So I think investors are reacting well. The companies are talking a really good story. So that's a great thing. The second thing is, Thursday we're going to have an OPEC meeting. And I think it's very consensus that OPEC is going to roll over their 400,000 barrel a day increase again this month. I think there's a lot of world leaders that want them to increase. There's a lot of pressure coming down. But if you look at some of the stats that have come out over the last week, it looks like global S&D is not going to be as good as people thought early next year. And so I think OPEC's going to take a little bit of a cautious tone, and I think that's how it's going to play out. Now, what we're starting to hear is the U.S., Japan, a bunch of other countries, these developed countries are saying you need to give us more oil or we're going to do something. Well, that do something might be an SPR release. It's probably not going to make much of a deal. Maybe it knocks prices down for a day or two, but the issue is right now through year end, they can do all they want. The market is very, very tight, and time spreads are telling you that. And so that's it on OPEC. And the last
Mike,
thing
Mike, just so we always get we're always just need to be totally clear. They're planning a 400,000 barrel a day increase. The question is, are they going to do anything incremental? Correct?
Exactly. The same thing we heard. The same thing last week. Last month at the same time that they were hopeful that they would raise, between 600,000 and 700,000, and they did not. And I'd say that some of the stats that have come out from OPEC here over the last month have been a little bit worse. And so the odds of them basically increasing, I just don't think are going to go up. I think they're going to go 400,000 barrels a day. And then you're going to see a reaction by, developed countries. And we'll see what that reaction is. And, we're going into this COP26 conference. And I think one of the goals that was coming out of there was, developed nations, undeveloped nations wanting developed nations to really step up their capital commitments on the order of hundreds of billions of dollars. And I found it really interesting in looking at a couple of slides here of why maybe that's going to be probably impossible and why some of these guys are dragging their feet. If you look at the slide right now, this is just a U.S. balance sheet, held at the Federal Reserves. You can see back here when the 2015 Paris conference occurred, the amount of capital on the Fed's balance sheet was roughly $4.5 trillion, and that was roughly 25% of GDP. And now it's up here at roughly $8.6 trillion and 38%, roughly 40% of GDP. And if you look at the second slide, this is the ECB balance sheet, the same thing. The blue line is their debt that's on their balance sheet, and it's essentially at back over here. It was at roughly $2.73 trillion. Now it's up here around $8.5 trillion, and as a percent of GDP, it went from 25 to 70%. So if you take those two combined, I think that comment by Prince Charles that nations are going to probably have to step up, but they don't have the debt capacity to do this. I think they're not talking about anybody else; they're talking about themselves, the U.S. and the ECB. And so I think this is why you're going to see a lot of these companies are not committing. They're going to be dragging their heels. That might have made sense 4 or 5 years ago. Much more difficult. And what we're going to see is, as they start to spend, it's going to be very inflationary. The cost is going to go up quite dramatically. And it's only going to lead to, nations really kind of just dragging their heels even more in the next couple of years. So I thought that was really interesting, something to think about as we come out of this conference.
Matt, those charts look like the U.S. E&P sector 3 or 4 years ago. We need to do some delevering. Let me turn it over to you and see what you've got for us.
I'm just going to hit on a couple of quick topics. First is actually in our new energy space. The team put out an update on the Lcfs market. And unfortunately, this is one area of the energy transition complex where we do expect to see some pressure on pricing for credits as we step into 2022. So what the primary update here was really just looking at the Q2 credits versus deficits, and we are starting to shift into an oversupply of credits. So for some context, we generated about 5 million credits this last quarter, and we had a deficit of about 4.8 million credits. It's really a rise in ethanol, RNG, and credits generated from electricity for EVs that is starting to pressure the market. And then with a lot of large RD projects coming on stream over the next 2 years, we do expect the market to see pressure on the Lcfs pricing. So for some context, the team is forecasting pricing, which currently is about $170 a ton, to fall to about $80 a ton by 2023 before we start to see a longer-term recovery as Lcfs credits start to expand into new regions. So big picture, this will impact kind of our views on the RNG market, the RD market, and broadly speaking, kind of profitability for the sector, something we are spending a lot of time working on and do have a lot of client interest in. If you have any interest in the deck the team put out, feel free to reach out to your contact, which in this case may be Maynard as usual. Away from that, just a quick recap on earnings so far. As Mike mentioned, I think a couple of key positives that have come out of the upstream space in general. First, actually CapEx has been under control. Q3 prints so far have generally been coming in below expectation, and we've seen upstream operators actually, in some cases, cut budgets in Q3 and Q4. So you're seeing better capital efficiency for the industry. We do expect that to turn in 2022. We are forecasting inflation to rise about 10% on aggregate for 2022 CapEx. So that will start to hit the numbers for the street. But overall, so far, things seem good, and that's leading to strong free cash flow prints for the sector. To a topic that we talked about last week, we actually saw a very nice response and follow through, and we're going to see, I think, a lot more from the Canadian space on this front. As we talked about coming off the road, meeting with investors in Toronto, one of the big things that a lot of clients wanted to see was a significant acceleration return of capital. And Suncor came out with a really hard-hitting move on their front. They doubled the dividend, up the buyback, and the stock performed up about 13% on the day. So we are starting to see some real traction with the Canadian group in general. I think that's going to allow the long-only investors to continue to add to equity exposure. And then lastly, just on the automotive space, wrapped up auto earnings calls. It is a very constructive setup in our view for 2022 for a couple of different reasons. One, the semi shortage, it feels like maybe the worst is behind us as of Q3. That's going to allow auto manufacturers to start to replenish some of the very depleted inventory throughout the 2022 timeframe, but we're going to continue to see strong ATPs and strong margins for the space, so that should benefit the auto manufacturers in general. Two, heard a real strong commitment like we're seeing in the upstream space of value over volume. So the auto industry is not going to chase adding back a lot of incremental capacity at low margins. They really want to focus on their margin structure going forward. And then three, we heard a lot about tech innovation. And, one interesting fact that I think stood out from the GM Investor Day was that they have investments in 20 new tech startups. And we're starting to see tech and automotive companies really start to emerge as they come out through the downturn here. And I think that's going to be a big theme for us and for the space, and is actually going to drive margin upside over time. So our takeaway from the conference call season for autos is that 2022 starts to become the recovery scenario for a lot of these big OEMs as the semi shortage falls, and we're going to see strong margins and strong earnings growth going forward, which should really help the stocks as we progress into next year.
Okay, awesome. Someday we'll have to get you to tell us what GM has, what those 20 investments are. I bet those are pretty interesting. Okay, Craig Webster, you were going to try to hit a couple of things, I think COP26 and the EPA's new comments on methane.
Yeah, so busy week on the ESG front, but the COP26 is underway. It's kind of as expected. The tone going into it was relatively muted. The G20 meeting leading into it and the days leading up to it didn't really seem to accomplish a lot. No hard targets. There's a lot of noise that comes out of it when we think about the big things that are trying to be accomplished. The $100 billion number as far as developed countries funding undeveloped nations or developing nations to fund energy transition and adaptation. There seems to be some confidence around that. Although I thought it was interesting when Prime Minister Modi was speaking, he mentioned $1 trillion number, and John Kerry's mentioned trillions that would be required. And it just sort of highlights that, $100 billion actually in the grand scheme of this probably isn't a lot of money. A big one that everybody's been talking about, the coal phase out, was again kind of disappointing. Making progress, incremental progress, but not the hard targets that on a global basis that everybody's looking for. One thing that is getting a lot of attention is the global methane pledge. There's close to 100 countries that are now signed up to it, which is really a pledge to voluntarily as a nation to reduce methane emissions by 30% by 2030, and of course that ties into what's going on here in the U.S. That is one of the positive talking points that President Biden has. We had a new proposed methane regulation by the EPA come out today, and so that's getting a lot of airtime from him over there. On that topic of the methane regulation, this goes back to the Obama era 2015 methane regulations. They were reversed by the Trump administration. These proposed regulations build on that. They apply to existing operations, not just new operations. There's specific standards in there that get pretty specific, specific around zero emission pneumatic controllers, monitoring, et cetera. And so, this is something that everybody's been waiting for. It's not new. And so we'll see what the comments are, but it's a big step as far as methane. And I would just note that in the latest version of the reconciliation bill, there still is a methane tax, as it's sort of colloquially referred to. It was in previous versions called a methane fee. It's now called a waste emissions charge. But again, it is a tax that starts at $900 and goes up to $1,500 over a couple of years, starting in 2023 for methane emissions above a certain level. So the one thing I'll leave you with on that is in that reconciliation bill proposal, there is a mention of how it needs to be based on empirical data and accurately reflect total methane. And it sort of leads to what's going on, which is leaving behind these desktop calculations that we use for the EPA right now and moving towards employing new technologies and really knowing what the methane emissions are. And well, that feels like it's a long way off. It'll be interesting to see what we find the actual methane emissions are once we start to deploy those technologies in a way that can be relied upon.
Okay, awesome. I thought for a minute there, Craig, you were going to say Prime Minister Modi asked to be paid in Bitcoin because he's worried about the dollar, but maybe we'll see that next. Colin, what's on your mind before we jump over to our Abernathy McGregor friends?
Listening to Craig's description of the tone at the COP26 meeting, we can really see the effect that European gas and power prices, and indeed the price spikes worldwide in energy, are having on policymakers and kind of the moves they're going to make to get to things done. And not only in COP, but even in the G20 meeting we just had in Rome, there's been this very muted sense and dampened expectations. And I think part of what's happening here is the surprise of supply and demand delivering this result has really caught policymakers off guard. And in particular, it's revealed that they don't have a strong handle on where supply and demand are today. And that's not a good sign, because it really suggests they don't have a very strong handle on where we're going. And so let me share just two slides. The first is this one. It's a scatter diagram that's showing global oil demand since 1965. And rather than a line graph, it's a little bit more complicated, but if you bear with me for a second, it'll immediately become apparent what you're looking at. So we divide the world into two groups: rich countries, which call themselves the OECD. There's 38 of them. That's this group of dots, and then everybody else. And each dot is 1 year of demand, expressed as 1,000 barrels per day per million people. And here on the horizontal axis, we have real GDP per capita. So 2010 dollars, inflation-adjusted dollars for all of these people. And of course, what tends to happen over time is the world tends to have more people and it tends to get wealthier. So you'll notice that these curves for demand tend to go from the bottom left toward the upper right. You'll also notice that in the rich countries, we had a big shock in the 1970s, particularly from 1978 into the 80 and 82 recessions that really hurt demand, came back. We had the COVID experience, and here we are today. And then in the emerging world, we started at a much lower level and have been meandering up. So that's the setup. And what's important to know as you look at these charts is that we're at about 1.4 billion people today in the rich countries, and that's about where we're going to be in 2050. And when we look at the rest of the world, we're looking at about 6.4 becoming 8.5 billion by 2050. So just a much larger population growth here than in here. And now I just want to make 2 points. The first is the 2021 demand level for oil across the rich countries is about 47 million barrels per day. Compare that to the 2021 demand level of the developing world, the rest of the world, 51 million barrels per day. So point one is this group, the developing world, is bigger demand-wise than all the rich countries. The second point is we build into our forecast pretty strong conservation measures. We acknowledge and expect that we will see more electric vehicles. We will see heat pumps in the northern states in the United States. We will see all sorts of fractions of jet fuel and gasoline be conserved, and that the curve for demand will decline. And while we'll have more wealth going into the future, and about the same people, we'll lose something on the order of 12 million barrels per day of this 47. And that's debatable. Maybe it's a little steeper. Maybe it's not as steep, but it basically looks something like that, which leads to the second point. The second point is this curve is actually going in the opposite direction with a very high probability because we are adding so many hundreds of millions of people. In fact, getting close to 2 billion people. So the additional demand to come is more on the order of 62 million barrels per day. And a quick math calculation here will say that if I lose 12 from these guys and I get 62 from this group, then I'm going to grow the oil market by 50 million barrels per day by 2050, which is not at all the story that you hear out of Glasgow today. But there's an even more powerful point lurking in this chart, and it's really the purpose of why we're sharing it with you today, and one that policymakers would do well to pay more attention to. Let's just say we are totally wrong. This curve doesn't have this kind of slope. It goes to zero by the time we get out to 2050. The blue dots are down here at about 70,000 per capita on GDP and zero demand. 47 goes away, but I still have my plus 62. Now I'm still growing the market, even though I lost all gasoline demand in France, all jet demand in Canada, all asphalt demand in the United States. All the rich countries lose all demand, including petrochemicals. There is no laboratory equipment. There is nothing, not even biofuels, because that's included in this statistic. and I still have a bigger market than I have today. And that's the core of the problem here. Now, you might say, well, how'd you get this number? Where's this coming from? In the short time we have, I'll just say that we are building in the IPCC's own numbers. These are the UN's own numbers for population projection, and we're using the World Bank's numbers for GDP. And we run it through pretty rigorous statistical tests, looking at all the standard errors and all the things that you would expect us to do. And if there's anything that's maybe a little squishy in this forecast, it's that this one could be, the rich country demand forecast could be a little bit steeper or a little bit more shallow. But this is a really solid forecast because of the sheer number of people involved and what's getting substituted away. We are losing dung and firewood for cooking purposes and heating in sub-Saharan Africa and the subcontinent of Asia. And it's being replaced by propane canisters. That's what's happening here. It's very, very sticky demand until we get to about $20,000 real GDP per capita. And then we'll see probably something like what we saw in the 1970s in the richer countries. It'll start to level out. But even by 2050, the developing world will not be to where the rich world was in 1965. And on this pathway, by 2105, we'll see the emerging world where we have the rich world today. So a really powerful chart. One last point, and again, I'm not going to spend a lot of time on this, but simply to make the point, showing this chart again, term structure here on the horizontal axis, the NYMEX WTI crude oil market. So to the right is bullish, to the left is bearish, and then realized volatility. And the punchline here is we're still in a bull market. We're still in a bull phase. That's what these green dots mean here on the 25% reading. But notice this 20% reading, very little volatility. Realize it's a bit of a complicated chart, but how does a oil trader think about that? Do not have strong dogmatic opinions about this winter or which direction is the next step in the oil market. Better to buy what the commodity traders call straddles, buy calls and puts at the same strike on the same month. Don't get too opinionated, just expect it's going to move somewhere in the near term. And so the way that the market, the oil market is thinking about risk now is in the short term. We've had price move a very large distance in a very short period of time. That chart's kind of proof of everything Mike said up top, about debt and interest rates and OPEC and the rest of it. And looking further out, that's when we pick up the demand side story. Back to you, Maynard.
Awesome. Okay. Thank you, guys. Well, Sydney and Blair, welcome to our COBT party. That's a lot of exciting things going on. The world of energy is pretty confusing, dynamic, changing constantly. It's the kind of thing that you help people manage through change, and you help people communicate their strategies. And so what a perfect time to have you guys. So welcome.
Yeah, thank you. A long-time listener, first-time caller. So thrilled to be here and appreciate the invitation. Can share a little bit about Abernathy McGregor, our strategic communications firm, as you mentioned. But we're really best known for working with companies during times of change. So basically, the same times that they would call the Tudor Pickering folks would be the types of times they'd call us. So mergers, acquisitions, restructurings and bankruptcies, proxy fights, de-SPAC transactions, IPOs, management transitions. And we try to cover the full 360 of audiences. So it's everything from heavy and investor relations, employee engagement, public affairs, digital strategy, customer communications, media relations. Based in New York, got about 90 people firm-wide. Blair is a managing director in our New York office, and I'm a managing director and lead our Houston office. And by virtue of being in Houston, tend to do about probably 2/3 of my work is energy related, which these days means a lot of energy transition, climate, ESG, and really corporate reputation for energy couldn't be more imperative right now. It's really existential to access to capital, access to talent, and license to operate, which all three of those could basically kill you. So doing a lot of work on reputational stuff related to energy in particular, in addition to a lot of M&A as the industry continues to consolidate.
Is there, Sydney, just before I was going to jump to Blair and talk about this employee activism piece, but is there anything in your energy work of late? I mean, you mentioned so many of the themes, but anything in particular popping up, or particular types of clients, or, it seems like the whole world is focused on its ESG report and those types of things, but I don't know, just curious for a little more on your energy practice of late.
Yeah, I'd say we can't have a single meeting without talking about energy transition or ESG. And the approaches that our clients are taking are really across the board. I'd say that the biggest challenge starts with investors. Everybody wants this transition to renewables, but they also want to make money. So, trying to help companies boil down their stories to ability to generate cash flow, distributions, returns of capital. I think Mike was talking about that as a key theme this quarter. Protecting the balance sheet, and then of course ESG trends. So those are kind of the topics that are on everybody's minds. If you can talk about your balance sheet, your cash flow generation capacity, and distributions, returns of capital, plus the ESG as icing on the cake, those are the key things that we're hearing from investors that folks want to emphasize.
Well, Blair, you guys were so nice to join. I honestly just reached out because I saw your employee activism piece, and that was really, pretty unique work. Do you mind talking a little bit about, I know you've been involved in so many big transactions and strategic things, but maybe a little bit about that piece and how it relates to your broader work with companies?
Sure. So I think even taking a step back and looking at employee activism more broadly without being in the context of M&A is a big trend that we've been seeing our clients at Abernathy deal with in particular over the last couple of years. And there are a million examples of employee activism that I'm sure you've all read in the news, everything from the Netflix walkout 2 weeks ago over the Dave Chappelle special to Amazon and Nike and Google. And these issues are ranging on everything from climate change to Me Too issues to COVID return to work policies and sort of everything in between. So that larger trend of employee activism is one that we've seen grow substantially. And when we actually see it happening is when employees are coming out publicly against their employer to demonstrate in some sort of protest issues that they feel passionately about. So they feel very comfortable coming out publicly and talking about these issues. They can often start just as internal conversations, but as Sydney and I know well, and in 2021, anything that's internal can become external very quickly. So that's where we've really seen it start to bubble up onto the surface. And as we think about how it relates to M&A, it's interesting because we haven't really seen yet a big example of a deal completely being thrown off the tracks as a result of employee activism on a public level. So we've seen it sort of behind the scenes fall apart because if the management team gets wind that their employee base hates a transaction, it can fall apart from that perspective. But it's interesting because it's a trend that we think will really grow over the coming years. And I think that's for a number of reasons, but most importantly, the fact that employees as a stakeholder group are more important than ever from a management team's perspective. So it's always been investors, number one. And now it's really investors and employees as sort of that number one audience. And so that is really driving the fact that management teams feel the need to communicate unbelievably clearly with their employees when it comes to M&A, especially because M&A is inherently deeply disruptive. Employees are scared of it. It means change. It means, would I report to someone else? Could I lose my job? Where is my office going to change locations? All those types of things make employees really nervous. And so management teams are focused on making sure that their employees have buy-in on any of these transactions that they're announcing.
So one thing that this is such a fascinating topic because it's got like economic forces and cultural forces and philosophical things involved in it. But I was just, as you were talking about that, Blair, it seems like we've seen in this supply chain stress that's going on, people are there's starting to be some labor unrest again. And so unions are exercising some power. Is that something that you get involved with?
Absolutely. And even outside of the current supply chain issues that we're dealing with, a lot of the work that we do is crisis related. And so unionization or unionization concerns definitely falls into that category, and figuring out how to manage that. And I mean, if you think about it, unions are sort of the original form of employee activism. It's employees banding together to negotiate with management to really get their perspectives across. And so that is actually one of even sort of the big things as we think about employee activism manifesting in M&A. Having a unionized employee base or unionization concerns makes companies who are thinking about M&A at a higher risk for employee activism, because that function is already there. So it's really easy for employees to band together in that instance and share their concerns with management.
But as you were leading into that, and you rattled off a handful of company names, and I was kind of wondering, is your experience with this, it's sort of like the which came first. It seems like some of the companies that you referenced were sort of, encouraged internal sharing, encouraged people speaking out, encouraged people having groups and get-togethers. And, I'm not doing a good job describing it, but it seemed like they encouraged it and now they're getting it. There's that group of companies, but then there seems to be another group of companies that they didn't necessarily encourage it and they're getting it too. So I don't know, is that something worth commenting on?
Yeah, I think that's very true, because this does tie closely to corporate culture. And Netflix, for instance, has always had a corporate culture that's very much speak out, take the entire thing apart and start over. And so I think you're right that it is interesting that sort of culture is now really manifesting in this way. But we've seen this across clients, again, not necessarily related to M&A, but from an employee activism standpoint, very sort of old school cultures where employees feel comfortable coming forward. And I think that's perhaps less due to the culture that's been created at the company, and thinking about other factors such as who makes up the employee base. Is it a lot of Gen Z and millennials? And are they digitally native? Do they feel very comfortable speaking out about these issues? And are they really socially engaged? And thinking about if there are other risks at the company that maybe there's already underlying resentment. Companies are coming out sort of on the other side of COVID. Employees are feeling burned out, exhausted. We're in the midst of the Great Resignation. All of those factors, even aside from company culture, can contribute to employees speaking out.
Yeah, and Maynard, I think when you ask kind of what's the appropriate role of the company when it comes to social issues, some of the techie type companies are going to be more forward on this than some of the industries such as energy. But that said, I've got a client that, especially after George Floyd was murdered, there was a lot of employee engagement and interest in the company taking a stance on racial issues. And this is an energy company that said, we usually comment on energy policy. Anything that could affect energy policy, we're going to chime in on. Anything that doesn't, that's not really our lane. And I think they really had to change that posture because of this interest of employees in particular. And then the question becomes, okay, if we comment on one thing, do we comment on everything? And so we spent a lot of last year in particular working with companies to create more of an objective framework for how you can evaluate when and how a company should chime in on these sorts of things. And it's really been a dramatic change over the last really few years that coincides, not coincidentally, with this concept of stakeholder capitalism and companies taking action and taking a stand on issues that would never have been on their agenda. But I will warn that everybody wanted to say something after George Floyd was murdered. Everybody felt compelled or pressured to have a position on that as a corporation. And there were some companies that I think got a lot of criticism for talking about it, but not having that being backed up with words, with actions. And I think the empty words is probably the biggest risk that companies can face. And so, if you just try to say, okay, our CEO put out a statement about this issue, no matter what it is, I think we're seeing a lot more of this interest in organic, bottom up, kind of representative communications, and not just, the CEO put out a statement type of communications.
How much of, this is like we've lived through this unbelievable chapter of COVID and a very, polarized election, and, some of these, like the George Floyd incident, and, it's just, and now we've got, so there's some things which are temporary and happened, at this point in time that explain a lot of this. And then there are other things which are larger and more longer lasting, like the stakeholder philosophy, the, millennials wanting their organizations to behave differently. How do you think this is just a continuing trend, or do you think in 5 years it may have moved in a different direction, or how do you separate the short term from the longer term trend?
I'll start. My opinion is that, yes, this is a fraught moment for our country, and we see it beyond social issues. I mean, it's a time of transition for the energy industry in particular. So there's a lot going on. But I think the broader trend is here to stay in terms of how employees expect their companies to behave and the relationship between the employee and the employer. And I've been at Abernathy for about 16 years, and that's the number one change in our work that I think I've seen is that, the employees' expectations and how the company communicates with the employees is the biggest change. And like I said, it used to be a lot of top down, a lot of kind of platitudey language without a lot of substance. And now there's a lot of meat on the bone, and it's a very representative process where you're engaging with people at all levels of the organization. And people want to know if there's a major change at my company, with somebody who represents my views part of the planning process, and not just, the edict from on high has decided this is what we're going to do, but it's a lot more of a community feel of, somebody who represents my position at the company or represents my views was part of this, and people want to know that that was a consideration.
It's funny when you listen to this, it's like, and I'm sure it's a mixture of everything, but one way to listen to it is that hierarchical companies that weren't great places to work are now becoming, they've got to get more engaged. They got to get a better culture. They got to listen. They got to, understand better. And that all sounds fantastic. But there's another part of this that sort of sounds like companies are becoming political entities, and they got to take positions on stuff, and they're not going to be apolitical, places where we work and bring people together of different backgrounds and different beliefs and work together. It sounds like this is sort of the woke, corporate America problem. It's probably hard to pigeonhole this into one or two of those buckets, and I know both of those things are happening. But is this a good thing overall, or what's your takeaway from it?
I would say that I think to your point, it definitely has sort of two sides to it. I think a large part of this is a push from employees for greater transparency. And to your point, to have sort of more flat organizations. And if we think back to even sort of the tech model that was invented of everyone can wear casual clothes and we can all sit out in the cubicles together. I feel like this is sort of that, but this is the 2020, 2021 version. I think it's here to stay, but I don't know that it will necessarily stick at every organization. I do think a large part of it is generational. I think millennials have pushed for a lot of this change, and I think Gen Z is coming in behind, pushing even harder, and they're the next workforce. And so I do think that, to your point, it isn't necessarily positive all the time, because it is putting companies in sometimes really difficult positions. And as Sydney was saying earlier, there's a new issue every day that a company could comment on and could stick their neck out there or could devote resources to a certain cause. And so as companies try and sort of figure out where they're going to focus their action, it's almost sort of similar to initial ESG reporting as companies 10, 15 years ago started to think about how they're going to position themselves from an ESG perspective. That's happening now, but I think at a broader scale, with ESG really being part of that.
Yeah, and I think you have to remember that the loudest voice isn't necessarily the representative voice. And there's a lot of loud voices right now on social issues in the workplace. And, an employee base is not homogenous. And I think companies have to be careful to not act too quickly to appease the loudest side. Because clearly you've got representation of all sorts of folks at a big company. And so, that's where I would say don't give in to one side or the other too quickly. I think there's a lot of pressure we see when companies are in crisis mode, for example. There's a lot of pressure to, we've got to get out there immediately. And I think as a firm, Abernathy, we try to advise people, stop and be thoughtful and really use some of the analytics to see what do your audiences think about something, and then take an approach that is objective and not reactionary.
Yeah, that's an interesting tension because it gets to the heart of the rule of law. Companies have to abide by G. They have to protect privacy laws. They have to protect safety laws. And it seems like there's a tension here where the Gen Zers, and I'm a parent of Gen Zers, want to maybe put the public opinion or their opinion ahead of the obligations on the G side. So I guess my question is, when you see a situation where maybe it's a sensitive corporate transaction and there's a leak, one can make the argument that the whistleblower had a legitimate argument to sort of go against the corporate code on social media or whatever their obligation was under the Securities Exchange Act. One can easily envision that they're just bonkers and it was a complete flagrant violation of law. And that's the tension that you just mentioned, Sydney. A company, any company is going to have to, sort of put kind of that governance conservatism ahead of kind of assuming the person was right. They got to sort of tick all the boxes. As their advisor, how do you manage that? Because we all like disruption too. We want to see, a ride sharing company come in and kind of break up some of these incumbent taxi companies. But we also have to have rules. We have to have obligations. We have to have protections of the employees, the environment, and so on. So again, how do you just deal with that G side as E&S really kind of clamor for the foremost attention?
I think an important point is to be made in terms of obviously anything that's sort of a violation is obviously would be considered such. And I think from a leak perspective, it's interesting because everyone loves to speculate on what was the source of the leak. So if we're particularly thinking about deals, that's the number one question that we get from management teams of who leaked it. And it's not necessarily as simple as people assume it to be. And it's frankly, it's usually more complicated. I think reporters are more enterprising than a lot of people give them credit for, especially in the M&A space. And so thinking about sort of how to actually manage that leak is where we focus our attention rather than trying to figure out sort of who done it. So really trying to actually not only scenario plan around those types of issues as we're thinking about sensitive transactions, but also then thinking about what do we say, who are the stakeholders who matter most, and particularly as we think about employees, making sure that we're staying within bounds, which is often telling employees we don't comment on market rumors or speculation, and making sure that we're staying within any bounds from a legal perspective, obviously, because to your point, Colin, a lot of these are really sensitive transactions that are happening behind the scenes that employees can't be a part of, even if they wanted to. So making sure that from a leak perspective, we're really managing it, obviously, within the bounds from a regulatory and legal perspective, but making sure that we've planned for all of those scenarios of how to potentially address them.
Just to Colin's question about kind of this tension of empowering employees, maybe a little too much. I think I would think about it as encouraging dialogue and input and a two-way communication rather than governance. So there's this, let's talk about it, let's get your input, let's have feedback from across the organization on what we should do. And then there's the people who take that under consideration and develop the corporate strategy. So, I think that's the distinction. And on the leak side, clearly a big headache for probably most of your clients and ours as well. When we engage on a leak, so if a reporter will call us and say, hey, I've got a story, I'm going to run it, you have an hour, get back to me, do you have a statement? Any engagement from that point forward is very coordinated with legal and with the client and with the rest of the advisor team. Within that, I'm never going to tell a client that we can stop a leak. That's just not possible, but we can sure try, and we can engage with the reporter. Sometimes we've said, if you can hold the story, we can give you the exclusive access on an embargoed basis when the deal is ready to go, for example. And these are like really ninja media relations moves that I would not ever try. This is like, don't try at home type of a thing. But there are ways of talking with the reporter on background and off the record to try to shape their understanding of a situation without going so far, of course, as to confirm or that any transaction is in the works. So that's a big part of our job that I think is a black box to people. And like I said, that is complicated, but if we have really strong relationships with the M&A reporters and we have that level of trust, then we can work with them to try to, at a minimum, shape their understanding of the story, even if they're going to still go out with it.
So Sydney, could I ask, because this is really, we said up front from, methane leaks to deal leaks, and then we had employee activism in the middle. So this is like fantastic stuff. On deal leaks, the energy community has been really plagued by it. Unscientifically, it feels like over the last year to 18 months, it's been whatever the historical percentage of leaks was, it's up a lot. And so if I was an energy CEO watching this, and I've got a transaction in mind, and I call you guys in and say, I cannot have this leak, what would you tell me? Of course, small team, of course, code names, of course, tight. But what are there any other tricks for keeping something from leaking that you could share, or just because this is a real problem? And a good friend tell me, the energy sector needs to do a lot of mergers to accomplish some of its goals. But if things keep leaking, it's going to prevent that. So this is a real issue.
Yeah, there's no silver bullet on preventing the leaks. I think, like Blair said, the reporters are really good at triangulating. So they might talk to one person who says, no, a lot going on in the midstream these days. And then they call the next person and say, oh, a lot going on in the Permian these days. And then, there's a lot of kind of triangulation, and they'll try to get people to talk. And so I think there's a lot of leaks that are probably more inadvertent like that, where the reporter really connects dots. I think there's also intentional leaks. I've never talked to anyone who has said that they have intentionally leaked anything. So I don't know how that's possible, but the leaks, a big deal. So we've done a lot of research into the prevalence and impact of leaks, and happy to share that with you all and anyone interested.
There's some good stats in there I think people would be interested in.
Yeah, and I think there's some scary stats. Definitely the size of the deal correlates to the likelihood of a leak. The bigger the deal, the more likely it is. And what we looked at is when a leak occurs, both the target and the bidder have a huge spike in media attention in the short term because everyone's speculating about this deal. And then when the actual deal is announced, presuming that it gets to announcement day, there's a little spike because it's old news at that point, right? And so at the point where everyone's paying attention to you, your hands are tied. And then at the point where you really want to go out and tell everybody this great news and shape it your way, nobody wants to pay attention. So that's where our work on the media relations side keeps us probably the busiest, is, like I said, can we try to shape the coverage behind the scenes at the point of the leak, which there is some kind of around the edges that we can do there, but then really planning for different scenarios. And then when the deal is announced, going out with messaging and a strategy for media relations that's really compelling and that will drive attention at the point when we actually want the attention.
Yeah, Maynard, to your question of what do we tell sort of the CEO when they turn to us and say, this deal won't leak, make sure of it. I think the two biggest things are, one, that we always put a plan on the shelf. So thinking about sort of leak scenario planning and what we would actually say or how we would engage with the reporter. And I think the second one is really educating management teams on the likelihood that the deal will leak. And I think preparing them for that reality, I think the earlier we can get their head around that as a distinct possibility, the better, because then if it does leak, it's not going to be necessarily this moment of panic. But the reality, and to Sydney's point of thinking about our research, it's almost 50% of deals above $5 billion leak. And certain industries more than others, but deals leak and the bigger ones leak the most. So it's important that we prepare our clients as the management teams for that potential.
Do you think has the industry of finding leaks and sharing leaks, has that industry grown? Are there just more people and organizations trying to find leaks and share them than they used to be? Is that part of what's going on, or has that always been the case?
So I would say that the M&A media in particular are really hungry and work really hard. So I think that's part of it. So every major financial publication has an M&A team, some bigger than others, and they've put definitely money behind those teams. And so as we think about sort of who's actually breaking the news, it's typically the M&A press, sometimes in conjunction with a beat reporter, but it's usually those reporters, and there's a lot of turnover, and they are out there that is their sole job as the M&A press, is to find the deals before they've been announced and report on them. So it's definitely a focus of the M&A press, and perhaps that is why leaks have continued. But I don't know, Sydney, if you have other thoughts there about sort of the cause of the increase.
Yeah, they're incentivized to break stuff. And so I think, if you put your press release out for your deal at 8 a.m. and you call a reporter at 8:01 and say, hey, let me walk you through this great transaction, they'll say, oh, old news, call the next guy. That's how the M&A beat works. The beat reporters who cover, for example, energy, would then write a more in-depth, thoughtful piece about what does this mean for the companies and the industry and the like. But the M&A reporters are just there to really break the news.
And do you have any sense of, I guess what I've always been struck by with these things is, so when the leak happens, it's terribly damaging, damaging to the controlling of the message, to the stock prices involved on either side, to the employees on both sides. Like, it's a really damaging thing. So that's the cost. I haven't been able to figure out the benefit, like why the model makes sense. I guess if you're an organization that puts it out, then I don't know, you sell more, subscription, but it just seems wildly out of balance because the damage that's done is huge, including it can kill the deal. But I can't quantify I'm trying to be really antiseptic about it. Like, it's really hard to understand the benefit other than the excitement over having done that. Is that totally unfair?
Yeah, I don't know that the reporters are working towards any public good when they break a deal. I think they're incentivized to get clicks, and everyone wants to click on, hot story in the market. So, I think that's their business model. For the companies, you're right, it can break up the deals altogether. You see the premium reported often is that, non-disrupted price. So the price, it's a premium to the price as of, Tuesday before it leaked on Wednesday. So, you see companies have to account for that when they're trying to position the valuation because it does mess up the relative valuation when something leaks. So you see us try to get around it by, talking about the price prior to the leak, but that gets a little cumbersome.
I think what you said, Sydney, was really good. I mean, Larry, you said a ton of good things too. But you said basically people are having these conversations with reporters and they think they're not saying anything. They think they said, oh, I just said midstream was hot, or I think I just said the Permian was hot. And they don't realize that reporter is stringing all of these nuggets together and figuring out, what is probably the case.
Well, Maynard, that goes back to my point about governance. I mean, every financial firm I've ever worked for, you're not allowed to talk to the press. It's a violation of your employment contract. So, we know humans are humans, and perhaps there's some forgiveness for, a young person who does that, or maybe not. But you just, maybe you haven't broken the law, maybe you have, but you certainly broke your employment contract. And so it's tough because, and the implication of what you just said is there is some benefit to the reporter, either through reputation or maybe advancement through their organization. And I'm not suggesting they're insider trading or anything like that, but they've benefited from being the one that did this thing. So, I think that's where I kind of come back to a G question. There's governance here, and we all want, like, if there's something wrong with our society, then challenge it, but do it through the right channels. Go to your management, go to Congress, change the laws. But it seems like there's all these bypassing snakes now that are what we're trying to catch. And I appreciate Sydney and Blair how tough it is.
Well, it's a good message for an election day, all about civic engagement.
There we go. One question, how about this? It seems like, 15 years ago, when a big transaction was happening in your world, it was quite popular to, maybe choose the Wall Street Journal, have a sit down with the Journal, have it hit the top of the fold. That was kind of the old school classy way to do it. And it seems like that type of thing has drifted away. And maybe if people aren't doing it that way anymore, that's contributing to, the kind of frenzy speculation, because no one's getting an inside look anymore. I don't know if there's anything here, but is there something we could do that would be better in terms of rollout that would somehow change all this?
It's interesting because sort of that change from 15 years ago, have a press conference in Midtown Manhattan where you stand at the podium and tell the reporters why it's great. That's really changed because of all of the different ways that we can now communicate with our stakeholders. And a big part of that is digital. So for instance, a transaction microsite, even that concept, which didn't exist 10 years ago, of building a specific website that can speak to individual stakeholders, it's really that change from having to yell one message to the media really loud and hoping that it's going to get to all the stakeholders who matter in your deal. Whereas now you can actually speak to all of your stakeholders completely individually with custom messages of why this transaction makes sense for them. And a big part of that is digital, but I think a big part of it is also the fact that all of these different stakeholders have rising expectations, and they want to know why a transaction makes sense for them personally, as a customer, an employee, a partner, whatever it is, and certainly as an investor. But that ability to speak to them individually, I think, is a huge change. And I think it's a net benefit because, to Sydney's point, it's no longer just sort of a template letter to employees saying, we're merging with company X. Good luck to you. We're really excited about it. It's much more dedicated from a company standpoint to make sure that all of their stakeholders actually understand the transaction and its benefits.
Well, I'll just mention one other thing on this ability to go to people directly through these digital and social channels, because a lot of my clients are energy companies and they don't have a really robust online presence. But I'll tell you, in M&A, I still think that it's worth having some tweets about the deal that go out, because that reporters are going to be following the company and they're looking to put out a story immediately. And so this gives them kind of the short version of you're basically taking the press release and boiling it down to the key points and putting that out through a series of tweets. And so as reporters and employees and others are trying to take wrap their arms around a really complex press release, if you can break it into these smaller and easily digestible bites, I think that helps your stakeholders to understand it a little bit better. And it's also a great discipline to have to boil down this really complex transaction to what are the 2 or 3 key themes. And so for those reasons, I actually like social media and M&A, even for companies that aren't really tech forward.
Yeah, that's a great point. Well, I know you guys just recently did a big a digital report. It's something. I mean, who knows? Maybe that's what we need. Maybe we need more executives in the classic energy space tweeting and saying, I think this, or I think that, or look at this great. I know there's a little bit of that, but can you imagine that happening in our space, Sydney?
Carefully.
You're like, proceed with caution.
Call your lawyer.
Well, look, this has been fascinating. You guys were so kind to answer all those questions. I know they get really complex around understanding today's society, but this employee activism thing is a big one. I'm sure we'll be hearing more about it. And we all want to stop leaks, both methane and deal. So we had a really good show today. Thank you guys so much for joining us.
Thank you. Have a good one.